hours after the declaration of a 2-week ceasefire in the West Asia conflict, the 6-member Monetary Policy Committee of the Reserve Bank of India, RBI, announced that the key policy rate remains unchanged at 5.25% and maintained a neutral stance, in line with what the street was expecting. The ceasefire, to some extent, has been taken into account, RBI Governor Sanjay Malhotra said in a media conference after unveiling the MPC's policy decisions. The whole implication we will come to know, but the ceasefire has been taken into account in the monetary policy decision. After cutting the repo rate by 125 basis points (BPS) between February and December 2025, the MPC has now kept the policy rate unchanged in the 2 bi-monthly reviews since then. Observing that geopolitical uncertainties have heightened significantly since the February MPC meet, Malhotra noted that upside risks to the inflation outlook, driven by increased energy price pressures, among other factors, have increased even though core inflation remains muted. At the same time, supply chain dislocations and the risk of second-round effects render the future inflation trajectory uncertain, he remarked. For the first time ever, the MPC shared projections for core inflation, which excludes prices of volatile energy and food items, in the April monetary policy statement. While headline inflation is projected at 4.6% through 2026 to 2027, relative to 2.1% estimated for 2026, core inflation rate has been estimated at 4.4% this year. The central bank assessed that elevated energy and other commodity prices due to the West Asia conflict and other supply disruptions are likely to impact growth in 2026 to 2027, and it projected a real GDP growth of 6.9% in 2027, down from the 7.6% uptick expected in 2026. Further escalation and wider spread of the conflict, heightened volatility in global financial markets, and weather-related events, however, weigh on the domestic growth outlook. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict, Malhotra said, noting that the FY27 GDP growth projection was way lower than the FY26 estimate. When asked about the thinking on interest rates staying lower for longer as indicated during the February policy, Malhotra said it is quite possible that rates remain low in the near to medium term, but it will depend on how conditions evolve. Malhotra acknowledged that the rupee depreciated more in FY26 than the average decline in previous years. The Indian unit depreciated over 4% in March following the West Asia conflict. This prompted the central bank to unveil regulatory measures, like capping net open position of banks in the onshore deliverable, and barred banks to offer non-deliverable contracts to their clients. Following these steps, the rupee changed trajectory and has appreciated 2.4%. The RBI stands committed to this. Exchange rates are market-determined policy, and would judiciously contain excessive or disruptive volatility to ensure that self-fulfilling expectations do not exacerbate currency movements beyond what is warranted by fundamentals, Malhotra said. Out of the 8 statements by the current governor, this statement is the most cautious, hawkish in our opinion. But that does not mean a rate hike is imminent, said State Bank of India Group Chief Economic Advisor Soumya Kanti Ghosh. We expect a prolonged pause as the natural outcome under current uncertain global environment, he said in a note. Economists at Barclays concurred that there may not be a rate hike anytime soon. The MPC seems convinced that higher inflation is, in fact, a supply shock outcome. We do not expect it to respond in any hurry via a rate hike, especially as the 2-week ceasefire offers relief, they said in a note. The governor noted that Indian banks remain resilient, and system-level financial parameters related to capital adequacy, liquidity, asset quality and profitability of scheduled commercial banks continue to remain healthy. He said bank credit maintained its upward trajectory and remained broad-based. The next meeting of the MPC is scheduled for June 3 to 5, 2026. Bankers termed the Reserve Bank's move to hold rates in its policy review on Wednesday as a prudent and well-calibrated measure. Sector-specific moves like the removal of the investment fluctuation reserve requirement and easing of CRAR, capital and risk-adjusted ratio, computation were also welcomed by bankers. The RBI's decision to maintain a status quo stance amid ongoing global uncertainties reflects a prudent and well-calibrated approach aligned with market expectations. C.S. Sethi, who chairs the largest lender SBI and also industry grouping IBA, said in a statement. Sethi said the regulatory moves will help strengthen banks' capital positions and help support credit growth on a sustained basis. Indian Overseas Bank's Managing Director and Chief Executive Ajay Kumar Srivastava said the status quo reflects a safety-first approach, wherein the central bank is prioritizing macroeconomic stability. A cautious stance is warranted amid evolving global uncertainties, particularly geopolitical tensions in West Asia and volatility in crude oil prices, he said. The removal of due diligence requirements for onboarding onto the T-REDS platform is a progressive step that will significantly enhance liquidity access and working capital efficiency for small businesses, he said. AU Small Finance's founder, Managing Director and Chief Executive Sanjay Agrawal said the decision to hold rates is a pragmatic one, which signals that the economy has resilience. Market has digested the RBI's caution about upside risks to inflation and downside risk to growth over the baseline scenario due to rise in input costs following supply chain disruption relating to crude oil, gas, and other commodities, he said. Standard Chartered Bank's chief executive for the country and South Asia, P.D. Singh, said the potential risks from the West Asia crisis resulted in the status quo in rates. The measures to enhance capital metrics through review of the incremental provisions on non-performing assets and the investment fluctuation reserve, improving ease of trade business for MSMEs, and development of the term money market continue the structural business-friendly measures announced by RBI, Singh said. Among the non-banks, Muthoot Finance's Managing Director, George Alexander Muthoot, said the policy reinforces confidence in India's economic fundamentals, and added that he expects credit demand to remain resilient in the near term as growth momentum sustains. There was no surprise in the first monetary policy of 2026-27, FY27, as the Monetary Policy Committee, MPC, the six-member rate-setting body of the Reserve Bank of India, RBI, left the policy rate unchanged at 5.25%. The decision was unanimous. The MPC also decided to continue with a neutral stance. One wouldn't call the tone of the policy hawkish, but RBI Governor Sanjay Malhotra seems to be preparing the market for an extended pause before future rate hikes. At the moment, the overnight index swap, OIS market, which reflects the future interest rate trajectory, is pricing in 3 rate hikes for the current year. That might be unlikely, but there could be rate hikes in future. When? Not too soon. The 2-week ceasefire in the U.S.-Israel-Iran war has changed the pitch, albeit for the time being. The 10-year bond yield dropped to 6.90%, 14 basis points lower than Tuesday's close. The rupee closed at 92.58 a dollar, 42 paise stronger, and equities roared. Though the policy was a non-event, the ceasefire announced on Wednesday cheered the markets. The MPC has recognized that the intensity and the duration of the West Asia conflict and its impact on the energy and other infrastructure are adding risks to both inflation and growth outlooks. At this juncture, the decision is to wait and watch the changing circumstances and the evolving growth inflation outlook. The RBI will remain vigilant, closely monitoring incoming information and assessing the balance of risks. The signal is clear. If the uncertainties continue and the supply-side shock intensifies, there will be a rate increase. In his post-policy interaction with the media, Malhotra was non-committal on the rate front. It is quite possible that low rates will continue for a long time. As I mentioned, structurally, Indian economy is very strong, very resilient, very robust. Structurally, long-term macroeconomic fundamentals, because of the various measures taken by the government, the RBI, and various institutions, remain very strong and continue to drive growth while at the same time keeping price pressures contained. So it is possible that even in the short to medium term, we will continue to have low rates. The governor flagged 5 critical concerns in his statement. While elevated crude oil prices could increase imported inflation and widen the current account deficit, disruptions in energy markets, fertilizers, and other commodities could adversely impact industry, agriculture, and services, reducing domestic output. It doesn't end there. Heightened uncertainty, increased risk aversion, and safe haven demand could impact domestic liquidity conditions, economic activity, consumption, and investment, even as weaker global growth prospects might dampen external demand and reduce remittance flows. Finally, adverse spillovers from global financial markets could tighten domestic financial conditions and raise the cost of borrowing. The RBI, of course, reiterated its commitment to remain proactive and preemptive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy. Higher energy and other commodity prices, coupled with supply shocks, would affect growth. Assuming the adverse impact of the West Asia conflict would not last long, the RBI projected real gross domestic product growth for fiscal year 2027 at 6.9%, 6.8% in the first quarter, 6.7% in the second, 7% in the third, and 7.2% in the fourth. There is a rider, though. There may be downside risks to the domestic growth outlook if the war continues. For the same reasons, the Consumer Price Index-based inflation for fiscal year 2027 is projected at 4.6%, 4% in the first quarter, 4.4% in the second, 5.2% in the third, and 4.7% in the fourth. Possibly for the first time, the RBI has given an estimate of non-food, non-energy inflation, core inflation, at 4.4%. Excluding precious metals, it's even lower, indicating that underlying inflation pressures are expected to remain contained. Still, there is a caveat here too. The risks are on the upside. Incidentally, the 4.6% inflation estimate is based on the assumption of crude price at $85 a barrel. The Monetary Policy Report, April 2026, released simultaneously along with the policy statement, projects average inflation higher at 5% in FY27 and 5.1% next year, assuming crude price at $90 a barrel. The language of the policy clearly communicates what the RBI is seeing and how it is preparing itself for uncertain times. MPC preserves policy flexibility, avoids knee-jerk reaction. The status quo on the key policy rates and the neutral stance maintained in the current meeting by the Monetary Policy Committee, MPC, the 6-member rate-setting body of the Reserve Bank of India, RBI, was no surprise. The RBI commentary, while retaining policy flexibility amid exceptionally high uncertainty, was justifiably cautious and vigilant. The RBI's articulation of supply-side shocks, weighing on both price and demand, and its conscious choice to avoid preemptive rate action, lent the current policy added significance as a meaningful reset of expectations. Accordingly, the 1-year overnight index swap OIS curve softened sharply by around 29 basis points during the day, and over 45 basis points during April, as the possibility of an imminent rate hike faded significantly after today's policy. Going ahead, the growth inflation outlook is heavily contingent on the duration of the West Asia conflict and the extent of damage to energy infrastructure and cross-border economic activities. The recent 2-week U.S.-Iran ceasefire and the reopening of the Strait of Hormuz are clearly positive developments, but a sustained easing of global uncertainty will hinge on concrete progress in diplomatic negotiations. Even though external conditions pose a significant risk, the RBI pointed out that the pause was also cushioned by resilient momentum in domestic activity across manufacturing and services. It projected 2025-26 economic growth at 7.6%, while sequentially moderating 2026-27 growth estimate to 6.9%, reflecting the possible spillovers from external headwinds. While headline Consumer Price Index, CPI-based inflation remains contained, supported by comfortable agricultural buffer stocks, strong Kharif output, and excise duty cuts, the RBI highlighted rising upside risks as higher energy and commodity prices impacted input costs, alongside emerging weather-related risks from a potential El Niño. The central bank accordingly raised its 2026 to 2027 inflation projection to 4.6%, with a visible pickup expected in the middle of the year. The RBI reiterated its commitment to ensuring sufficient liquidity after infusing durable liquidity of around $3.5 trillion through open market operations, OMO purchases, and $20 billion in forex swaps in 2026 so far. The recent administrative measures augur well for credit flow to productive sectors, like industries. Weighted contribution of industrial credit to overall bank credit has started inching higher in recent months, from a markedly low print about 6 months ago, and has scope for further expansion. In sum, the RBI commentary clearly acknowledged the deterioration in global growth inflation dynamics, while consciously avoiding overreaction, given the domestic economy's comparatively resilient fundamentals. Through a demonstrably balanced policy outlook, the RBI effectively alleviated market concerns of a knee-jerk response, a reassurance evident in the softening of the OIS curve. The current policy configuration thus reinforces a wait-and-watch stance, with the balance of risks tilted towards supporting growth rather than prematurely constraining it. Importantly, even in the absence of a policy rate action, the RBI retained a broad and flexible toolkit, encompassing calibrated liquidity operations, targeted prudential measures, and discretionary foreign exchange interventions, allowing it to aid credit transmission, manage the rupee's volatility, and preserve orderly market conditions.